Very excited about my presentation that I have chosen based on my teaching and research I do at University of Wollongong. And the title is Sustainable Finance. Who are the key players and what are the key considerations? Before we look into the main topic that I have chosen, I would like to discuss what are the key risks the global leaders are considering that they will have severe impact in the next 2 years and 10 years. So based on the World Economic Forum Global Risk Report, out of 10 risks, 8 risks are related to environment and social. And here comes the role of managing the sustainability risk. And if you look at like general audience, whoever they are, if you look at their searches on the Google search, we see a significant increase in the demand of ESG information. And that increase we can notice from 2017 onward, and that aligns with the TCFD framework when it was introduced in 2017. And if you look at what is happening in the practice, in particular in US, we see the ESG and sustainable investments, they have also significantly increased over the period of time. In particular, from 1995, $639 billion to 17.1 trillion in 2020. And we see a significant increase from 2012 onward. Okay, so what is sustainable finance? As we have been talking about, it is the consideration of environmental, social, and governance factors into the investment decision making. And who are the key players that deal with this ESG information? So there are three key players. The first is the corporate issuer, then comes the rating agencies, and then the investors. So if our focus is on investors, if investors want to use the ESG information in their investment decision, and this is what sustainable finance is, they have to rely on the disclosure by the corporate issuers. For example, BHP, Commonwealth Bank, any company that issues the bond and equity, what information they are disclosing on those E, S, and G factors. And then investors can directly assess the information, but not all investors have that capability. And then they rely on the rating providers, which have the research team to assess the information related to ESG disclosed by corporate issuers. If you look at the corporate issuers, so they have a choice like voluntary versus mandatory. So some of the jurisdictions have already mandated the disclosure, but some of the jurisdictions are still in a process to move away from voluntary to mandatory disclosure. So let's say if we are living in a voluntary disclosure regime, then the company have a choice either to disclose or not to disclose. Let's say if the company decide to disclose, then they have various disclosure frameworks to pick from. So those disclosure frameworks can come from general sustainability, which includes environmental, social, and governance all together. And they can also be linked to specific disclosure, TCFD in particular, that is linked to the climate-related financial disclosure. So now the issue that happens here for investors, like if it is a voluntary regime and companies can pick any of these options, then the issue of comparability of the information for the investor is a big issue. There is an effort going on the standardization of the disclosure frameworks, and you can see a flowchart here, which is highlighting how different frameworks available over the past are coming together, and there is a standardization process happening. So in that front, International Sustainability Standard Board, which was established in 2021 at the COP26, have come up with the general sustainability requirements and the climate-related sustainability requirement. So what's the outcome that we are hoping from this is the comparable, robust, and the verifiable information available to the investors. So then comes the rating providers who assess this information that is being disclosed by the corporate issuers. As it is with the disclosure frameworks, there are many disclosure frameworks, and we are moving towards the standardization. Same is the case for the rating providers. So there are a number of rating providers available. So what they do, they take the input ESG information disclosed by the corporate issuers under different frameworks. They process it based on their rating methodologies, and they give a rating or a score to a corporate issuer. For example, Refinitiv, if you look at how their rating come together, this chart shows that picture. And if you look at the bottom, how many data points they are using? 630 data points to come up with one score. And there is a process involved in between. When you look at S&P Global, how they come up with this score, they use 1,000 data points, and they come up with a score that investor can rely upon. And MSCI ESG score have also different data points they pick on environmental, social, and governance factors, and they come up with the rating score that investor can rely. So now if we look at the correlation among the ratings provided by these rating providers, we see the correlation is not that great. So it ranges from 13.9% between S&P Global and ISS to 64.5% between S&P and Sustainalytics. So now what issue it creates? If the rating is not correlated, then the issue of divergence is there. So I'm giving the hypothetical example. Think about a company A. It is rated by provider 1, provider 2, and provider 3. A different rating can come out. Provider 1 is giving high rating, AAA. Provider 2, A rating, slightly lower, and provider 3 is giving much lower rating of B. So now if I'm an investor and I want to invest in company A, is this company doing well on ESG, or is this company not doing well on ESG? There is an issue involved here. So what are the factors that basically cause this divergence? So one of the factors is scope. What rating agencies consider as input? 630 points by Refinitiv or 1,000 points by S&P Global. So what they consider is to be included. And how they measure those 630 data points and 1,000 data points, that's another area that causes the divergence. And how much importance they give to those data points, that's the weighting. But based on the research, most of the divergence comes from measurement, how each data point is measured. And second is the scope, what is considered in coming up the rating, what are the ESG information and data points used, and less of the issue is with the weighting. What is the implication then for the fund managers and investors? If the investors have capability, like fund managers, the large institutional managers, what they should do, they should conduct their own research. In particular, for the stocks that have greater divergence, if they do their own research, the future performance of the fund is going to be increased. And this is shown in one of the working paper. So what I see as a next step, with the standardization of the disclosure frameworks happening, more comparable, robust, and verifiable information disclosed by the corporations. That's the first thing. So the rating agencies will have similar information to rely upon. And the artificial intelligence, the machine learning, textual analysis will facilitate in coming up with the measurement and the quantification of the numbers. So I hope that in the next few years, with these advancements, there will be more convergence in ESG rating. So before I conclude, I have few questions that I want to raise. The question is, what can you and I do together to foster sustainability? So we have only two options. The first option is do nothing. Finance as usual. Don't consider E and S factors. They are the top risk, as I have shown in Global Risk Report. Out of 10 risks, 8 risks are linked to environmental and social. Do nothing. They are going to come and eat your returns in the long run. That's a short-term approach if we want to adopt. Second option, do something. And that is sustainable finance. And you don't need to do something bigger at the start. What you can do, you can start with the exclusion. Let's take an example. We are a bond investor. We want to lend money to company A. Company A is in a business of, let's say, fossil fuels, tobacco, weapon. What we can do at a bare minimum, we exclude those companies from lending money. We don't lend money. But the issue in that approach is if we don't lend money, someone else will lend money because they're still operating in the market. Then what we can do as a next step? Next step is the ESG integration. What does it mean? The company may be poorly performing on gender equality, on renewable energy, on overall ESG, but we lend money to that company, charge higher premium because that company have a risk, material risk that is linked to E, S, and G factor. And if we believe on that, we will charge higher premium. That's the second step. And the benefit of this step is we can engage and vote on the projects of the company. If we are shareholder, Otherwise, as a bondholder, we can decide not to give future lending if they don't abide by the covenants that we put forward. And the final optimal step is impact investing, green bonds, and social bonds. We can give lending to the projects and companies that want to achieve the better social and environmental outcomes. For example, affordable housing, or it can be renewable energy projects. So I leave you with a question. What single action you can take to contribute to making the world a better place for everyone? Thank you so much for your listening.